Good morning, good afternoon, good evening, and welcome to Martyn Lucas Investor. We're now going to talk about cons in the dividend space. There's always going to be somebody down the pub who tells you they found a way to make money and make you feel stupid because you're just boring and you only invest in the S&P 500. And I know better. They're very rarely a financial advisor. They have no real financial experience. However, they've been drawn into a very clever marketing plan to get them to buy into a stock or an ETF that promises huge amounts of returns, yield, dividend payouts, and it looks amazing and really attractive. And then they'll gladly tell you that you are stupid because you own Standard & Poor, the S&P 500, and you only make a small amount of profit in dividends. And I know best because I make 70, 80, 90, 100% dividends. That's what I'm talking about. I've called this video The Shocking Truth About YieldMax's ETFs. There are many, but we're focusing on YieldMax for now. There's one particular one here. There's a whole branch of them. It's a bit like ARK Invest. They have a whole array of products and services designed to draw you in, to get you to give them your money, and they will invest on your behalf and make money for you so you get rich. Sound a bit weird? It should do if you think about it just for a moment. And I'm going to give a real life example of this, that we're all easily succumb into nonsense and we don't even realize it's happening right in front of us. So buckle up for this live event because this should scare you if you are thinking of buying into an ETF or a stock that promises huge dividends and huge gains, and you think that this is a great idea. Very rarely it is. I'm going to use this before I give you the numbers. I'm going to give you this example. If you are a frog and you are in a boil and you are in a glass of water and you slowly turn up the heat, eventually you'll boil and die. And you're not even aware of it. You just get a bit warm and you get a bit warm and you get a bit warm and then you pass out. And you're not even aware of it. And this actually happened to me today. You may remember I went live from my phone while driving Leah's car today. I had a bit of a crisis to deal with. I won't go into it. It was Leah's business, but I had to deal with something for Leah today, so I couldn't stream as much as I wanted to. And what was interesting was at the end of my meeting, I was given a car to drive. And I'm not going to go into the details, but essentially I walked out of this building towards a car that I thought was the car that I was going to get into, and somebody had just turned up in that car and was jumping out of the car. It was their car, and I was stood there with my hand on the door looking into the car as if this was my car to drive away, and it wasn't. But the point was, because I expected it to be, it appeared if it was. And in fact, everything about it, if I stood back and thought about it, was nothing to do with the car that I was about to be given, wasn't even in the same realm. But because I was expecting it and it was sold to me, I thought this was the reality. I stood there and the poor lady got out of her car wondering why I'm looking at her, and I'm wondering why she's looking at me. Because it wasn't the car I was supposed to get into. The point was, though, because I thought it was, I could see it and visualize it, even though in my mind it didn't make sense, I went along with it until I woke up. Fortunately, in this case, it was just a matter of getting not in the wrong car and getting in the right car. But if it was down to an ETF like this nonsense, I would have ended up losing all my money and not aware of it until I'd lost all my money. So it happens to all of us. I hope that analogy kind of makes sense. But anyway, YieldMax. Now, it's part of this company here. You may have heard people on our channel have told you that this is the way to make money. Buying dividends like this can make you lots and lots of money, and we're all daft for buying the S&P 500, and it's all rubbish. But if you look here, this is the company. This is the company that provide YieldMax Universal Fund. There's lots of them. But you look here, and it reads here, YieldMax ETFs seek to generate monthly income by pursuing options-based strategies. Options-based strategies. They have to put that in the headline. You have to know what this is. But you are buying an ETF based upon options. Now, you all know if you buy a business, a stock, you own the business. You own a piece of the pie. If you do options, you own contracts to buy or sell, but no obligation, a future price of a stock. There's a huge element of risk and gamble and unknowns and uncertainties. Options make money for those that set them up all the time. It's like a brokerage always makes money when you trade. An ETF, a managed ETF, always makes money when you trade. Whether it goes up, down, sideways, pays out, doesn't pay out, they always make money. You might see now where I'm going with this. I don't want to give a spoiler so early in, but I think you start to get the idea. This is an options-based strategy. So if you don't like or understand options trading, you shouldn't be buying options-traded ETFs. Now, I don't even believe in options. I don't like it. It's some people leverage options, which is throwing gas on top of a burning building already. You really don't take that level of risk, but some people do. Okay, YieldMax's aim to harvest compelling yields from assets that are not typically associated with monthly income. Not typically associated with monthly income. And there's a reason for that, because those assets that you are buying through this ETFs don't have a monthly income because they don't produce one. But we're going to synthetic is the key word here, synthetic options. We are going to create one for you out of thin air because we can do that. So actually, it's all here in the opening paragraph, but no one really understands what that actually means. Now then, you might notice what they also do is they do ETFs around options around your favorite stocks. So you could just buy Amazon. You could just buy Nvidia. You could just buy Meta, Facebook. Now, you might notice they've still got FB. They're still a bit out of date there. This website is very, very basic, and there's not a lot of work done here, and I'm going to explain about that in a minute as well. But this is an example of a product which is designed to draw you in. You might notice all the sexy names. TSL, Tesla, all right? Innovation stocks, a bit like ARK Invest, Apple, Nvidia, Amazon, Facebook, which should be Meta, but anyway, FBY, Google, Netflix, Disney, Microsoft. Hang on a minute, what's going on here? AMD, PayPal. I think you get the idea. We don't need to go on with this too much more. But these are stocks that you can already buy just on their own, but those stocks don't provide a dividend. Why? Because they are growth stocks. You earn money from growth. The performance of the stock is what pays you if the business is profitable. This is not what that is. This is not like the S&P, which tracks the success of those businesses. This is an ETF based upon options, essentially gambling, taking some risk with your money on your behalf. So what do you get out of it? What is the point? Why would I buy this when I could just simply buy the stock myself and get the growth? Well, good question. And the answer is quite simple. And when I say it to you, you're going to laugh and you're going to go, well, that sounds obvious. Why did I not think of that? Well, before I give away the spoiler, I will show you the numbers. We don't take Seeking Alpha analysts opinion on anything because they're paid to say it. I'm a Seeking Alpha analyst, except I refuse to do any work that they pay me to do. I don't make these reviews for fees. I do them all for free. I could do this for Seeking Alpha, promote their services and get paid to do it, but I choose not to because you wouldn't trust me then, would you? But people do. These are the people that say, hold, it's a great idea. Whereas the AI software, which just looks at the facts, says sell, get the hell out of this. It's rubbish, right? Momentum, D. Now, you might notice that this particular one is very, very new. They're creating them all the time. Very few have any history. That should give you another clue. D, expense ratio, F. Now, before I carry on, I'll show you this. This is insane, all right? Anyone who buys this is down the pub with their mates telling them, this looks amazing. Look at all this percentages. Look at all this. These are all the allocations of the other ETFs. This is an ETF made up of other ETFs. Just think of that for a moment. This particular one is an ETF made up of other ETFs in the same company. Why do I need other ETFs I could already buy individually that I'm paying you to manage? You're starting to probably work out where I'm going with this. If you're not, you probably shouldn't be investing. But anyway, let's look at it. Volume, 1.5 million. Average, 1.47. Big problem there with such low volume. Let's look at the yield. 77% 30-day yield. Oh my God. I'm on Robinhood. I'm browsing through my phone, sat on the toilet. I've discovered anyone who buys the S&P is a flipping idiot. I should be buying this high dividend stock. It pays me 77% every 30 days. This is brilliant. Why do institutions buy the S&P? Why is it the standard throughout the world? I don't know. They're all idiots. I know what I'm doing. I'm going to buy this. Expense ratio. Oh my God. 1.28%. Does that sound a lot to you? Probably not. You might think 1.28. That's not too bad, is it? 1.28%. 1.28%. That don't sound too bad, does it? Well, it doesn't until you understand what it should be. Let's go and look at the S&P, which is a passively managed fund. I don't need people all day, every day getting paid by me. And there's your first clue, another clue, by the way. I don't need you to be managing that because all I got to do is hold those companies that are making money. That's all I need to do. Let's look at the expense ratio of the S&P 500. I don't know why I do this all day, every day, and all of a sudden I don't know where everything is. There we go. 0.03. 0.03. Now it's 0.09, I think, if you want to actively manage, which is a SPY, right? But this one is 0.03 compared to our grand total of 1.28. Now that's not just the story, though. That should be enough to get you to run the other way. And you can see another thing here. People that buy this think it's great. They buy another one and another one and another one and another one and another one. Look, these are all you do not see. Do you see this? You do not see the S&P 500. You do not see Berkshire Hathaway. You do not see solid companies, Coca-Cola, Pepsi, who are dividend kings over many, many, many years, very successful businesses. You don't see. You see another YieldMax, another YieldMax. So once people get into this, they think they've sussed it out. They think they're going to get rich, and they buy another one and another one and another one. They tell their mates down the pub, I'm going to buy another one. These are the greatest things in the world. Why is everyone not doing it? Everyone else is an idiot. I'm smart. I've sussed it out. Well, the reality is, if you do this for a while, after a period of time, you're going to have a lot less than you would have had if you just simply put your money in the S&P and left it there and did absolutely nothing. You'd simply left it there and did absolutely nothing. Okay? So, the first thing you need to understand is And it's kind of obvious when I say it. You're all going to go, okay, kind of obvious. Should have realized. This is regarded as a high paying dividend stock, safe, under management, and all the rest of it. The momentum is D. Expense ratio is F, as low as it gets. Dividend is A+, but they're not linked together. Dividend is not in comparison to your expenses. It's a really high dividend, which it is. But the risk is C. The S&P 500 is A. It's extremely risky. You've only got D and F, and it's the worst risk of all. But if it's a dividend-paying stock, there should be no risk at all, because dividend stocks are regarded as passive income, safe stocks. There's nothing safe about this. Now, if I show you, there's two more things to tell you. First of all, since inception of this particular one, and remember there's new ones coming out all the time, this one's only been around since January 2024, just over a year. They're constantly bringing out new ones. There's a sucker born every minute that thinks this is a great idea. If you calculate what you've earned in dividends, and then you've taken out the expense ratio, because that would have been added, that was automatically taken out, by the way. So what they advertise is not what you end up with. You might do your sums and go, I'm expecting $10. Why did I get 9 or 8? There's a reason for that. The expense ratio comes out. And then you look at how much money your stock has actually lost you, and you've underperformed the S&P 500. But don't worry. It's not all bad. No, it's not all bad. There's a silver lining to this story. Somebody wins. A lot of people win, and they make a lot of money. It's just not you. And what basically happens is this. And I'm surprised I've even got to say this, but I've got to say it. The reality is, there's no free lunch. Might not be a surprise to you. What also may or may not be a surprise to you, Wall Street managers, which is what this is, are not in the business of making you rich. They're in the business of making money from fees, transactions. That's it. That's what the New York Stock Exchange does. That's what hedge fund managers do. How do I know? I speak to them on X and Instagram. If you want my links, there it is. There's my X and Instagram. They make money out of providing services that you will buy and trade and invest in, and they will charge you fees to do it. Do you think, for a moment, just think of this for a moment, let's just say that you have $100 invested in this, and you're paying 1.8%. So you're paying $1.80 per $100 to the management fund. Do you think it costs them $1.80 per $100? No, not even close. Not even close. Because SPY can do it for 0.09. The Standard & Poor's S&P VU can do it for 0.03, and trust me, they're making money. They're charging an exorbitant amount of money. Why? Because they know that this is a short-term venture. It won't be around for long. They'll start a new one, and somebody else will start signing up for it, telling their mates down the pub it's the greatest thing in the world. This is not a good way to make money. It's not a surprise to anybody. There's never been a free lunch. There's never been free money. There never will be free money. This is a really, really bad idea. So if you see a stock, an ETF that promises you huge amounts of gains, by the time you extract the expense ratio and you see the portfolio literally collapse, just keep going down, that should tell you something. But there's two final pieces which make this even worse. And I guarantee your mate down the pub doesn't know this and hasn't even looked. Here it is. If you read the prospectus of this particular ETF, as in all of YieldMax's ETF, if you actually read the small print in the prospectus, there are two things in there which it tells you. Legally, it tells you. First of all, and I guarantee no one who's ever bought this has ever read it. Here it is. First thing is, look at the price of the stock. It looks cheap. It sounds cheap. It draws you in. Tells you you're going to earn buckets of money for doing nothing on a $16 stock. There are two things written in the prospectus that I had to spend hours to find, but when I found them, I thought that would be the conclusion to my video. And they are simply this. The ETF that keeps losing you money was the intent of this ETF. It's intending to lose money on purpose. It's built to lose money on purpose. It's the structure of this stock. It can't go up. If it went up, guess what happens? Wait for it. Spoiler alert. Headline to my video. Written in the prospectus. Before your mate tells you down the pub he's discovered the best stock that it pays him 60, 70, 80, 90, even 100%. You can get this for Nvidia. You could get this for Tesla. You could just buy the business. But no, you want to pay for an actively managed fund at 1.8, and they are higher. Some of them are over 2%. Not only is it in the prospectus that the stock was built to lose money, it has to pay out the money until it runs out of money. It doesn't matter when it goes to zero because the managers who run it got paid to run it. It even tells you in the prospectus, if you read it, punchline, that the gains are capped. I repeat, the gains are capped. So there is no way that you could actually make money on this stock. You think you're making money because they're paying you out these dividends. They are coming directly not from the performance of the stock, but the profit from the options and the fees. If that is not the most perverse, ridiculous nonsense you've ever heard, I don't know what is. This was designed and advertised and marketed for people that have no idea of what they're talking about to buy. And then they will tell you they've discovered the greatest thing in the world. And this will often be people that do not have a voice. You will not see big YouTube channels with millions of subscribers telling you this is the way to go, because there are too many ways to check it out. It would probably be some small YouTube channels telling you that, trying to make a name for themselves because they've discovered something great. They have not discovered something great. What they've discovered is rubbish, but they'll buy it because it sounds great, and they haven't got to read the prospectus and study it. All the money that's made from these ETFs goes into the pockets of the hedge fund managers, those that run these systems, the Wall Street managers that set these things up. They only last for a short period of time. But that is the reality of what you're seeing here. They can pay you from the exuberant profits they make to produce these. It's in the prospectus that the damn thing was supposed to lose money. And it's also in the prospectus that should any way it break out of that for some miracle, your gains are capped. What stock would you buy where the gains are capped? If you buy any of these super high yielding dividends, you've never read the prospectus. If you have, you don't understand what you're reading. You are simply donating your money to the managers of these funds. I hope you enjoyed this broadcast. I do not expect it to get many views. Most people will not pay attention to this. They will think it's not important. It doesn't matter to me at all, but I had to do it. Recently, we've been hearing about people who know a great deal about dividends, and they are the greatest things, and so on and so forth. So I thought I would spend some time, a couple of hours, reading some documentation to find out what these are all about. And as expected, I just lost 3 YouTube subscribers. Whenever anyone reports on this sort of stuff, speculators, gamblers do not like to hear it. Real investors don't care either, because real investors weren't buying this rubbish in the first place. However, it's my responsibility that I take upon myself to do what's right for you, my members. Watch it, don't watch it, like it, down like, unsubscribe, do what you like. I've read the prospectuses. These are the facts. Let me read some comments very quickly on this one. Why have I got a feeling this video is to do with fight? Well, it's got nothing to do with Fight Channel, but it did lead me to have a little look at the claims that he was making. And I can tell you this is one of his favorite ETFs. And it certainly wouldn't even be even on my radar for a maybe. So there you go. This is nothing like ARK ETFs. YieldMax is an options-only ETF. ARK is not playing with options. They have more risky ETFs than others, but they are not doing options. I don't know about every single ARK ETF. I can't say. I'm not talking about ARK ETFs. I'm simply saying when I mentioned ARK ETFs as a comparison, I was talking about management fees, exorbitantly expensive management fees. So there we go. How is dividend yield of 77% even possible? It's not possible. It's just a number they advertise. It may never be paid out. It may be paid out once and never pay out again. At the end of the day, it's being paid out of the fees, making sure the stock goes down, making sure they sell them. All they're doing basically is selling the stock plus their fees. It goes down. It can't make any money just to be able to pay you your ridiculous fees as long as it keeps enough for them and makes them a profit. It's ridiculous. Anyway, applauding, whoop, whoop, applauding, bunga, bunga, I think that was. I have YieldMax and MSTY Fight Channel. Thought these were good to have for dividends. I'm planning to sell out these even though the dividend payments looked good. Vanessa, why would you ever consider taking financial advice from Fight Channel? With the greatest respect in the world, Vanessa, you are one of my friends. Why would you do that? Fight Channel thought these were good to have for dividends. I am planning to sell out these even though the dividend payments looked good. Please take your money. See, now there is an example. There is an exact example. Vanessa is a lovely lady, very intelligent. She has bought a dividend-paying stock because Fight Channel said. There is my because it sounds amazing. Vanessa, I'm just assuming, and I don't mean to throw you under the bus. It's not my intention at all. But did you read the prospectus? I'm guessing not. I read it on your behalf, and I want to say that because the fact is, it's a good example of someone so smart, which you are, someone so nice and all the rest of it. You trusted someone. You didn't read the prospectus. Read the balance sheet. Read the prospectus. Understand what it is. JT Tegger says, wow, this info is perfect example how Martyn Lucas Investor helps us not to lose money. Not losing is winning. Absolutely correct. If you never lose, I never lose. 20 trades, 20 wins, always going up, then you are in a very, very strong position and, you're always going to do well. When are you starting Hood earnings? We called pump. Yes, I am covering the earnings in the next couple of minutes. Stand by. This is good information. It's just in the prospectus. It's just in the balance sheet. It's no secret. He might have forgot about Hood earnings. I have not forgot about Hood earnings. It's my next event. I have not forgotten about anything. Thanks for the heads up, Martyn. Won't be investing in this. Please go and read it for yourself. Okay, I'm surprised you never analyzed Fight's investments in the past. I'm glad you did finally. The reason why I didn't is because I trust everyone. I trusted him on my show, and when things didn't work out right, I thought, let me have a look at what's going on here. I trust everyone until I know better. One of them is up 235% in a year, said Song for Space. I think we'll all think one day it'll dip heavily because the small dip investors, I have bought these way before Fight said info on it. I made dividends and sold all for profit. I got in low and sold high. I'm not saying that you can't make money on it. If you buy it when it's low and then it goes up and you take the profit, maybe you can. But as a dividends paying stock was designed that you would live on the dividends, you would leave it in there long term. That's not what you should do on this stock. Okay, I missed it. What did you find? Okay, that's it. Done. All right, thank you very much indeed. Div can always sell a chunk each time to make sure you don't lose. Crag Financial, nice one, Mike. If I can get in and get a massive dividend, can always sell a chunk each time to make sure you don't lose. All right, that's it. We're now going to go into the Hood earnings. It'll automatically take you there. The Hood earnings starts now. The call starts in 30 minutes. Of course, I'm not going to miss it. And how would I ever miss it? There you go. There you go. There is the link in the chat. This is the event. We're going there right now. I hope you're enjoying these back-to-back live streams that I'm doing, answering all your questions, all your reviews, everything that you've ever wanted to know, things that you've asked me to do. That's what I'm covering. Yes, I did. Thank you, Mike. I got everything fixed. Let's go straight over now to the Robinhood earnings. Stay right where you are. It's time for Robinhood earnings. Take care of yourselves and each other.